So our next speaker is Jonathan Burke. He's the AP Giannini Professor of Finance at Stanford Graduate School of Business. Before that, he was for many years our valued colleague in the Haas School of Business here at Berkeley. His research is primarily theoretical in nature and covers a broad range of topics in finance, including delegated money management, pricing of financial assets, valuing a firm's growth potential, the capital structure decision, and the interaction between labor markets and the financial markets. He's also explored individual rationality in an experimental setting. He's authored 2 finance textbooks, Corporate Finance and Fundamentals in Finance. The first edition of Corporate Finance is the most successful first edition textbook ever published in financial economics. It is a standard text among almost all top MBA programs around the world. At Stanford, he teaches courses in institutional money management and critical analytical thinking. Jonathan will be presenting his paper, Impact of Impact Investing, joint with Jules van Binsbergen. Jonathan.
Thank you very much. I have to, as Bob mentioned, I spent 10 wonderful years at Berkeley, and I have to say, driving over here today, I got very nostalgic, and looking out at the bay, I'm very nostalgic. It was a wonderful time I spent at Haas at Berkeley. Okay, so let's talk about ESG investing. I'd like to start at the beginning. One of the interesting things about this paper is I'm asking a question in the paper that in a literature that's over 20 years old. And it's somewhat astonishing to me that the question was never asked before. Okay, I mean, it seems to me it's a pretty obvious question. And I think we should think about, as a group, certainly as a research group, why that question wasn't asked, and to the extent to which popular culture is actually driving research and affecting science. So let's just start with the very first question is, divestment is this huge thing. Everybody talks about it. I don't know of anybody who ever talks about it. Well, okay, how is divestment going to change the world? Seems like if you're going to follow the strategy, that should be the first question you asked. Okay, and it's not often asked. So let's think about that, right? So if I sell a company, by definition, I'm selling to somebody else. So all that's happening is a change of ownership. It's hard to understand why a change of ownership, it could possibly affect how the company does business, right? So let's think about that. Well, there are only 2 ways that change of ownership can affect how a company does business. The one way is the new owners exert their rights of control. Now, it seems hard to believe that that is going to be in any way beneficial to the, if you're divesting because you want to change social outcomes, if you're divesting for the social good, it's very hard to understand how that would lead to social good, because you've swapped somebody who cares about social implications with somebody else. So the average amount of people who care about social has to go down, right? Or it could stay the same or go down. So I can't see how that would, and then the exercising of self-control, the exercising of control would in any way cause the company to be more socially beneficial. So that can't be the explanation. So the only other way it could happen is by divesting, you change the cost of capital. So let's understand how that would work. Okay, so the world's in equilibrium. Everybody's happy. One investor wakes up one day and says, I don't like this company. It's an oil company. I'm divesting. Well, he has to sell to somebody, and before everybody was happy. So that means in order to sell to somebody, he has to induce somebody to suddenly want to buy. And the way that happens is he has to lower the price, right? So when I choose to divest, I have to sell at a discount, and the price is lower. And what does that mean? Well, if the stock price is lower, that raises the cost of capital, all else equal, right? So the act of divesting lowers the price and raises the cost of capital. Now, if a company is facing a higher cost of capital, that means there are less positive NPV investments. If there are less positive NPV investment, the company is not going to grow as fast. At the same time, presumably, the person who cares about the social good is buying companies, right? So the opposite effect, it's the opposite effect on those companies. If he's buying a company, he's raising the price, lowering the cost of capital, increasing the number of NPV projects that company has, raising the growth rate. Okay, and so what that means in the long term is good companies grow faster than bad companies. They perform a bigger part of the economy. And so through that mechanism, we're doing social good. So that's the only mechanism I can think of where divestiture is going to lead to socially good outcomes. And the question today on the table is how big is that effect? In other words, for that to work, you have to materially change the cost of capital, right? And so the question is, how much does a divestiture strategy change the cost of capital? So that's the question I want to talk about today. Okay, I'm going to do this in two ways. By the way, interrupt me. Those of you who know me, and many of you do know, I interrupt other people. My view of research is it's not a conversation. Actually, it's my whole view of teaching. I don't think people lecturing are teaching, because nobody learns by lecturing. You learn in conversation. So I want to be interrupted. All right. So I'm going to do this two ways. I'm going to build. This is the part that I find surprising. I am going to take the standard model in finance and just within that standard model, ask the question, from a theoretical point of view, if you divest, how much, from a theoretical point of view, do you expect the cost of capital to change? And I will say that it's surprising to me that it's taken 20 years for somebody just to do that simple calculation. And I think we, as a group, certainly as a finance researcher myself, and certainly I think of myself as a scientist, I think you have to ask the question, why? Why did it take 20 years? And to what extent are people's desires within the research community, I'm not talking about outside of within the research community, what extent are people's desires to get a result in order to make their lives easier, affecting science? I think we should worry about that. Okay, so standard model. So it's the capital asset pricing model. Everybody knows the capital asset pricing model. So the standard model in finance, here's how I'm going to do it. Okay, so I'm going to sit there and say, I've got the capital asset pricing model, okay? Start with an equilibrium where all investors are identical, right? So the equilibrium, if you remember, there's a mean variance efficient frontier, there's a tangency portfolio, everybody holds, the tangency portfolio, that's the market, and then they take a lever position in the market in the efficient frontier. Standard capital asset pricing model, okay? Then I'm going to say, in that equilibrium, let's introduce a fraction of investors who have ESG preferences. So those investors say there's a subgroup of stocks they refuse to hold. So just intellectually, just think about what that means. So that means we're going to have an equilibrium for them. They are going to be on a constrained mean variance efficient frontier, right? And there will be a tangency portfolio on that frontier, and they will hold a levered position in that tangency portfolio. Then all other investors will be on the regular mean variance efficient frontier, right? There will be a tangency portfolio, and they will be in a levered position on their tangency portfolio. But of course, neither of those tangency portfolios are the market portfolio in general, right? So in this world, the market portfolio won't price directly, right? And that's the world and then I'm going to ask the question, now let's look at the price of a ESG portfolio. We don't have to worry about individual stocks because nobody holds an individual stock in any diversified equilibrium, right? So let's look at the portfolio of the portfolio ESG investors hold, and let's look at the other portfolio, and let's look at the difference between those portfolios' returns and the returns in those same portfolios in the other equilibrium. And then that difference will tell us the effect on the cost of capital. That's what I'm going to do. So let's do it. Okay, so the assumptions are, you have to be a bit careful here. I mean, I'm not going to knock any other papers, but you have to be very careful. The reason you have to be careful is the capital asset pricing model is in many ways a very exceptional equilibrium model in economics because you're making assumptions on equilibrium outcomes. Returns on equilibrium outcome, they're not exogenous outcome. The model is perfectly fine, but you just have to be very careful when you work with the model that when you want to make changes, it's to exogenous parameters. You can't make changes to endogenous parameters. That's part of the equilibrium. So let's be careful, okay? So exogenous. I'm going to assume people have mean variance preferences. The K measures their risk aversion, okay? There are going to be two kinds of stocks. They're going to be clean stocks and dirty stocks. There are two kinds of investor. Gamma fraction of investors are ESG, 1 minus gamma are the rest. Now, the exogenous assumptions, okay? All stocks, it's a one period model, all stocks pay a liquidating dividend D. D subscript E is the liquidating dividend paid to holders of the ESG portfolio, of the portfolio of clean stocks. D subscript D is the rest, the total liquidating dividend of the rest of all stocks. And I'll be more clear exactly what these things are. But remember, this is something that's exogenously specified. Okay, so now more exogenous definitions. So the exogenous definition is, this is the cash flow variance, of the two portfolios. This is the cash flow covariance. I'm going to make a very simplifying assumption. If you guys ever work with the capital asset pricing model, and in an earlier life, I spent a lot of time working with the capital asset pricing model. This is a really convenient normalization, which is you assume the market portfolio always has price one. You can always normalize one asset, but you normalize the price of the market portfolio to one. If you do that, that of course means the return of the market portfolio, the variance of the return and the variance of the cash flow variance are the same. And it also means when I look at those two equilibria, I know that those variances stay the same. So that's pretty useful. And then I'm going to define the covariance as the standard covariance, but the cash flow covariance and the return covariance are the same because of the nature of correlation. The cash flow correlation and the return correlation are the same because of the nature of correlations. The covariances are not, and this is an important thing to remember. So what that means is you cannot assume the covariance of returns exogenously. It's part of, you solve that as part of the equilibrium. And it's important to keep that in mind because when you compare two equilibrium, which is what I want to do, I've got to make sure that I'm comparing, I'm not making assumptions on equilibrium outcomes of which the covariance is an equilibrium outcome. Okay, so just with all that said, let's do this. Let me formally define the clean portfolio. So the clean portfolio is the portfolio of clean stocks ESG investors hold. So it's the constrained, optimal, tangency portfolio for clean investors. Okay? That then defines the dirty portfolio as whatever it takes to add to that portfolio to get the market portfolio. Right? So that's how I've defined the clean portfolio and the dirty portfolio. And with Bob in the room there, I'm gonna make sure, because he'll notice this, that what that means is the dirty portfolio that can contain clean stocks. It depends on the equilibrium. Okay? But the clean portfolio only contains clean stocks. Okay? I'm going to assume that there's a risk-free asset in zero net supply, which means, so if that's true, I'm going to assume ESG investors have B invested in the risk-free asset, meaning the rest have minus B in the risk-free asset. Okay. And of course, the risk-free return is endogenous because the normalization is the market, price of the market, not the risk-free return. So the risk-free return is not the same in the two equilibria. Okay. Now, you can do a lot of math. I'm going to spare it to you. But the question is, in the equilibrium with ESG investors, I want to know what the difference is between the return of the dirty portfolio and the return of the clean portfolio. Now, let me just show you what this is. 2K sigma squared is the market, I'll show you, it's essentially the risk premium. So what this says is the difference between these two is the risk premium Now, if I was using the mean variance efficient portfolio, then it would be the risk premium multiplied by the difference of the betas. That's standard capital asset pricing model. But I'm not, because I want to see since I want to be able to compare these things. What I've done here is say, I've expressed this difference in the market betas. Now remember, the market's not mean variance efficient. So it's the market betas and an extra term, this term over here. Okay? And so that's the statement here. So this in the ESG equilibrium with impact with environmentalists, the difference in return of the two portfolios is given by this expression. Okay, now in the equilibrium without ESG investors, it's a standard capital asset pricing model. So it's going to be the risk premium multiplied by the difference in the betas. I can't put an M there. I've put a star there. And the reason I can't put an M there is it is the market. So it's the same portfolio as I had before. However, the betas are not the same. Right? The betas is an endogenous variable. It's a function of returns. So the betas in the equilibrium without investors, the market betas in the equilibrium with ESG investors and without ESG investors are not the same. But what I'm going to show you is that difference is second order. Okay, so here's the equilibrium without ESG investors. Here's the equilibrium with ESG. If these betas were the same, then what I want to know is the difference between this and this. That's what I'm getting at. That's what I'm trying to calculate, the effect of the ESG investors on the cost of capital. If the betas were the same, I'd have this very simple expression. It would just be this term. What I'm going to show you, what I argue in the paper, is these two are not the same, but the difference is second order. So for the moment, I'm going to assume they are the same, okay, and just get the first order effect. So if you get the first order effect, you do the subtraction. In any standard cap equilibrium, 2K is this term here, which is the market risk premium divided by sigma squared. So if you plug that in and you do the subtraction, you get this incredibly simple formula for the effect in the equilibrium of a divestiture strategy. So what is it? It's the market risk premium multiplied by so V is the value of the dirty portfolio. Remember, the market portfolio has been normalized to 1. So VD is the fraction of wealth in the dirty portfolio. Then this gamma is the fraction of ESG investors. So it's the fraction of ESG to other investors, multiplied by 1 minus the correlation between ESG stocks and dirty stocks squared. Now let's understand this. It's actually very intuitive to understand. I want to start with the most important term, which is the last one. Okay, let's think about this. You go to the grocery store, and there's a price of apples and there's a price of oranges. And the apples and oranges is in equilibrium. Supply equals demand. And you decide, I've changed my mind. I only want oranges. Right? Now what happens? Well, the market's not in equilibrium anymore. Prices have to change to induce somebody else to buy more apples. The price of apples changes, okay? We go back to equilibrium. And the question is, how much do the price of apples change? The price of apples will change based on how other people care about substituting apples for oranges. So if the rest of the world couldn't care less, the price of apples and oranges will change by very little. But if everybody else says, no, I want mine. If you want me to change from one thing, you've got to induce me. The price has to change by a lot. So the substitutability is a key determinant of how big the price change is. What is substitutability for stocks? Substitutability for stocks is covariances and correlations, right? That's what determines substitutability. So this term here is the substitutability term. And the thing is, this number here is very, very high, right? Most stocks are highly correlated with each other, meaning they are highly substitutable. And that's going to be a big problem. Because if stocks are highly substitutable, it means if I refuse to invest in Exxon, inducing somebody else to buy more Exxon doesn't take very much. Right? So this is, I think, the most important term. You multiply that by the effects. Obviously, the ratio, if there are lots and lots of ESG investors, so if most people are ESG investors, even though I don't care, that's going to force me way off my optimal portfolio. And then I'm going to demand a big price change, right? Because I'm not in my optimal portfolio. So if you have a lot of ESG, so this term is a lot of, if the value of if the fraction of the economy makes up dirty stocks is very high, that puts a lot of pressure on everybody else to hold them, and again, causes a large price effect. Okay, and then that is all multiplied by the market risk premium. So this is the formula that tells you how big the effect is. Now, I'm just going to do something really simple. Parameterize it. We can measure all this stuff. Let's measure it and find out how big the effect is. Okay. So I'm going to use throughout this presentation the FTSE for Good index. I'll talk about this in more detail in a bit. But essentially, why pick that index? We picked that index because the largest index fund in the world during our sample, BlackRock just overtook him, but the largest index fund in the world, the Vanguard index fund, uses that index. And I have a very serious problem in this, I'm sure you do too, in this whole industry. Everybody's got their own view of ESG. My view as an economist is, put your money where your mouth is, okay? So I know, because Vanguard is following this, these are people making real investments who care about ESG. So then I can be certain that this is people putting their money where their mouth is. And so that's why we use this index. So the Vanguard for Good index is a strict subset of the Vanguard US index. And so because of that, that defines portfolios for us. The for Good index is the clean portfolio. Everything else is the dirty portfolio. And we can use those numbers to parameterize. So that's what I'm going to do, okay? I'm going to get onto this in a second. It turns out, I mean, sometimes you just luck out. And I was lucky enough to present this paper at a practitioner conference where it was a FTSE practitioner conference, and the person FTSE put it on, and they had the technical people there. And at the end of the presentation, the guy said to me, Jonathan, you know that Vanguard doesn't actually use the for Good index. No, on their website, they say that's the index. No. We have a special index for Vanguard. So FTSE produces a special index for Vanguard that doesn't tell anybody about. So that required us to go back to basics. So there are 3 indexes. There's the main index and then 2 for Good indexes. The red one is the regular one, and the green one is the for Good index that FTSE does for Vanguard. So Vanguard then traces. I'm going to do both. Okay, and you can see the for Good index, Vanguard for Good index has more stocks than the one they generally use. Okay, what do you say?
What's left out in the select?
I don't know why Vanguard. I presume it's because Vanguard. Here's what I think. I'll show you some more other anomalies. I think Vanguard was, rightfully so, worried about transaction costs associated with holding an index, and wanted to make it easier for themselves to track the index without having to hold everything, right? And so I think that's what's driving it. And you'll see there's some other evidence to suggest it too. I don't know. All right. And so this is the largest social index fund it's the largest, and until 2021, it was the largest in the world. The strange thing is, it's kind of interesting. The BlackRock people are here. BlackRock started out at nothing, and then in about a 2-year period, the ETF just blew up and blew Vanguard out of the water. So I don't know what happened in the competitive environment. All right. They were uncompeted, put it that way. Okay, so fine. Let's parameterize based on that. So if you look at those 2 portfolios, you measure the correlation at 0.93. The dirty portfolio makes up 27%. And by the way, I'm now using, primarily we're going to use the Vanguard specific index because that's real money, right? So that's what. So this is parameterized using Vanguard specific. So FTSE for Good Select, it's called. The dirty stocks make up 27%. Now we needed to get gamma, and the way we did gamma was we said, okay, why don't we just use mutual fund investment? So we look at all mutual funds, and we then calculate the fraction of mutual funds that have ESG criteria. Now this is not so easy to do because, who knows? So you start with Morningstar's designation, okay? And then we hand check the top 20 because most of the money's in the top 20 and verified, yes, the designation is correct. Okay, if you do that, you get slightly less than 1%. And then we said, well, okay, what if Morningstar has missed? What if there's other funds out there? So we doubled it to 2%. But the bottom line is a very small fraction of mutual fund investment is invested in ESG specific funds. So if you, yeah.
On all your indices, are they pure divestment? ESG is conceived for good. It's just divesting bad stocks, not specific other added towards green stocks or high ESG.
I don't know. It is just what FTSE defines to be a good investment for ESG people. I mean, the space is a very difficult space to navigate, right? Because everybody has their own little thing. The ratings don't agree with each other. So, I don't even know what, so to me, the right way to approach this as a researcher is to say, how much money, is there money behind it? And there is money behind this. I know that. And that's all I know.
There's a little bit of a shift from before you're talking pure divestment.
Well, but no, it is pure divestment because remember the FTSE for good index is a subset of the diversified index. So there are stocks in the for good index that are not in the main index. And those are the stocks presumably people don't want to hold. So it is a divestment, right? And they're holding it in market weights. So they're not, these are market indices. So they're holding it not market weights, they're holding it in proportionate weights given the set. They're not, the FTSE isn't choosing stocks over some other stocks. Okay, so if you do the calculation, so you multiply these things out, you get 0.44 basis points as the difference. And we can all agree, given the imprecision in capital budgeting, that 0.44 basis points couldn't possibly make a difference to any investment decision. So it's nowhere near, it is so far away from having any effect, it's laughable. But then you could say to me, come on, Jonathan, how do you know your parameters are right? So, okay, there's this group called, that has this trade group of ESG investors who in 2020, I'm sure it's much higher now, claims that 33% of investment money is under ESG guidelines, okay? Now, that number is ridiculously high. Could not possibly be, but you may wonder, how do they get the number? The way they get the number is they send out a survey to organizations and they say, do you use your ESG criteria in managing money? So if they sent that to BlackRock, BlackRock would answer yes. And then they would take the entire AUM of BlackRock and say it's all ESG. So that's where they're getting this number from, yeah.
It's arguable what that even means. I think the FTSE for good includes tobacco stocks.
Self-reported.
For example.
Well,
It's going to be
exactly.
Everybody says.
Everybody has ESG, so it's going to be 100% soon.
How could you call that an ESG portfolio if it's got tobacco?
I don't.
That's like the original sin.
Not me. I'm not making these decisions. Okay. So, but if you use 33% as the number, okay, you still get 10 basis points. Again, 10 basis points is not enough to make any difference to any capital budgeting decision. The other thing you could do is you could say, let's look at all the mutual funds in the world. Let's identify the ESG mutual funds, look at what they're holding, and take the union. The problem is the intersection you don't want to do because, remember, for most mutual funds, they're not indexes. So they are holding a stock for two reasons. An ESG fund. One, it's ESG, and two, it's a good investment. So they are ESG funds they don't hold because they think it's a bad investment, right? So the intersection is problematic. So you can use the union. Okay, so this is the union of all stocks held by socially conscious mutual funds. In that case, it's a bigger set. So VD is now 18%. and grow is 0.8. These two things offset themselves. So if you use this as the measure of ESG funds, you get 0.79 basis points. So there again, the numbers are just not large enough to make a meaningful difference. And the final thing is to ask the question, what would it take, right? How many socially conscious investors are required in order to have, and we picked arbitrarily, but I think it's right, a 1% effect on the cost of capital. Because I mean, 1% is getting to the point where it's going to have it, where it's going to be a meaningful effect, okay? So you get a 1% effect on the cost of capital. Now again, I want to be very clear about this. How do we do this? Because I'm now moving endogenous variables around. The way I do it is I parameterize the model to today. From that, I infer what are the exogenous parameters that give me today's numbers. I then hold those exogenous parameters constant and then move it around, right? And so here's the result. So what you see here is in order to get a 1%, so 100 basis points effect, you need over 80% of investors to care about ESG. Just as a quick aside, the red curve is the actual, because of course I can calculate the actual, and the black curve is the approximation, where I assume the two betas are the same when they're not. And as you can see, the approximation is very, very close, right? So the simple formula is a really good formula to use. Okay, so what this says is this is not, my conclusion here is I'm going to take a stand whether you should be an ESG investor or not. That's your business. But if you do care about this kind of stuff, this is not the way to go. If you think about it, since in one of the parameterizations, the union of all stocks, the dirty stocks are only 18% of the economy, right? And you don't need a majority to affect control, right? But even if you took up a majority, that's 9%. So you only 9% of investors need to be ESG in order to take control of the companies and change their policies. So if you really care about this, what we're saying is do the exact opposite. Don't divest, invest, and exercise your rights of control. Okay. So now the second half of the paper is empirical. Let's see if this works. Here's what we're going to do. So what are the problems that plague the literature in this area? Okay, one second. One of the problems that plagues the literature in this area is when people run the studies, they need to control for risk generally to look at return differences. The dirty companies are often very concentrated in industries, and there's no reason to believe those industries, we measure the betas of the industries very well. And so there's been a tremendous amount of contradictory results in the literature, but whether this helps returns, hurts returns. So what we decided was we want to step away from that. So we wanted to do a method where we did not have to measure the risk of the company, right? Because frankly, I don't think we're very good at measuring risks of a company. So what we're going to do here is we're going to just look for the effect of a company either entering the Fugit index or leaving the Fugit index, okay? And see if that has any effect on the price of the company. Yes?
So there are a bunch of legal and institutional constraints that make it hard for shareholders to influence the behavior of the company. And I mean, you could argue you could change those laws, but that may be a problem with your alternative strategy.
I would say two things. First of all, I would say, if you have a majority, you can do what you want. You can take the company over. I mean, look, the best example right now is Elon Musk. He has a problem with Twitter, or he just bought the whole company, right? So, I think I would also say that, there was this hedge fund bought Exxon and put two board of directors on Exxon, right? I mean, okay, I don't know what exactly they had in mind, what they were actually going to do at Exxon. I mean, Exxon's an oil company, right? I mean, hard for me to understand. I mean, what do you want? You could just shut Exxon down. You could shut Exxon down. That makes sense. My guess is that there'll be other people who develop those oil fields. I mean, but So I think in this idea of taking over the company and effecting change, I think you have to be very clear in your mind what exactly you're going to do. Because I mean, an oil company is an oil company. You know, I don't know. You can't. It's hard to know how you're going to produce clean oil. So that's a different story. Yeah.
Well, I mean, it's, for example, hard to get a shareholder ballot measure on the ballot. A lot of the holdings are in institutions which may or may not be willing to.
Well, but if you have a majority, you can just change the board of directors.
Well, I understand that, but in most cases, you're probably talking about relatively small investors who are not in a position to just go and bid for the majority in the way Musk bid for Twitter.
Yes and no. I mean, I think one of the big worries, at least for me, in finance, is the fact that the indexes hold such a big stake in companies, and they have very lot of power. So,
right.
If you're an index fund and you an ESG index fund, and they're you're big, you're going to have power because it's only 18%. Just the fund you can set up
Okay. So what you're saying is an ESG fund, instead of doing an index, should say, our goal is to further ESG goals, and we will buy Exxon and we will vote.
Yes.
Okay.
It wouldn't take that much, right? I mean, I do, yeah. So you could do it that way. I mean, I just would. And and that's something you could do, and I think it'd be far more effective. I will say this: you'd want to think through about what you're going to do, right? I mean, it's one thing. I have this podcast, and we did a whole thing on ESG, and so say you said, look, I'm against opioid addiction. I think we can all agree on that one, and so I'm no longer going to invest. I'm going to take over. Whatever Pharma, what's the name of the thing? Purdue Pharma. I'm going to take over Purdue Pharma, and I'm going to say, we're not producing any more opiates. That's it. Well, my guess is somebody else will produce the opiates. I mean, you have to be very careful. I think I am very concerned about our government and the lack of government in this country, but the idea that some of our private business is going to step in and do what governments do, I think it's a bit naive. I mean, yeah. So anyway, yeah.
So just a question about good and bad. Does the definition of good and bad matter? Because we had this discussion about Philip Morris being part of the S&P ESG similar type of index. You can discuss whether that's relevant, appropriate, etc. But to your model, does the definition?
It doesn't. And so what I'm going to do now is just ask the question. When a company moves from ESG, from good to bad or bad to good, do I see a price effect? And the important thing is, at least for this index here, for the yellow index, I know there's real money behind it because Vanguard is going to trade on it. For the red index, I don't really know. I don't know what the hell's going on there. I'll do it for both. But the yellow index, I know real money moves. So this is not just somebody's, idea of something. Okay, so Vanguard has two indexes. So the big question you'd say to me is, Jonathan, how do I know that there is movement in the index from the for good to the regular index? So what we've done here is we've plotted the length of time stocks stay in the index, right? For both indices. So this is the FTSE USA index, and this is the FTSE for good index. If you're on the diagonal, it means you're in the for good index and the US index exactly the same amount of time. The most important thing to realize is there's a large number of stocks that are not on the diagonal, meaning they entered later or dropped sooner. So there is data here. There are changes in ESG ratings. This is for the for good index. The for good select index, that's the Vanguard index, is this one. As you can see, there's some anomalies here, right? The index is supposed to be a strict subset. The fact that this is above the line means it's not for some cases. They're all cases of the stock leaves the main index, but stays in the for good index. And I suspect it has something again to do with Vanguard trading. The Vanguard basically says to FTSE, look, pull them out, but can you pull them out slower so we can get out? I mean, it wouldn't surprise me. Some of these stocks are small, so they're worrying about that. So that's why I think there are these cases, and it's not very many, and so we're just going to ignore them. Okay. So here's what we're going to do. We're going to create a dummy. Okay. It's going to be 1 if it's in the US, the FTSE US index, and 0 otherwise. And we create a second dummy. 1 if it's in the for good index, and 0 otherwise. Okay. So with both of these dummies in the regression, this dummy will measure, and regression returns, I'll come to in a second, but this dummy will measure the return difference between the two. But obviously, measuring returns is a very difficult thing to do. We only have 20 years of data. That's going to be real, and it's a very small number. So the whole point of the theory section is there is a difference, but it's very, very small. The idea that we'd actually detect it on a return is pretty unlikely. So we're going to do something else. We're going to subtract these indexes from the previous observation. So we're going to lag it by 1 and subtract. What that's going to do is give us the delta index. So the delta index is +1 when it enters, -1 when it leaves, and 0 otherwise for both of them. And this index will then give us the price effect. Right? Now that's an easier thing to see than trying to measure the return effect, right? Because the price effect is the capitalized value of the return. So it's a bigger effect on price. And so then that's going to be our main variable. Okay. So just to give you a sense, so that for good select, this is the Vanguard one, that's the regular one. For good select is we have data from 2005 to 2020. The main one, we have 2001 to 2020. Okay, so the for good index has 872 constituents, 872 adds, 795 subtractions. The select has 508 adds, 653 subtractions. The most important thing to realize is this: when there's a confluence of the two, and as you can see, it's not high compared to these numbers. So most of the time when it's entering the index, the for good index, it's not the same time it enters the main index. Okay. This is the main regression specification. So we're going to put all those 4 dummies in. Okay. Obviously, this dummy measures the expected return difference, the average return difference, and this dummy measures the price effect. Okay. So then let's see what we find. So what you find is everything is very close to 0, nothing significant, not too surprising. I mean, these are still very small numbers, but they are definitely in the realm of what we expected. So let's talk about the price effect. So we get a price effect of either 21 basis points or 48 basis points. Now you need a duration of a stock. The average stock has a duration of 50, so that's going to bring us right down to less than a basis point. But of course, there's a lot of variation. I think we can agree the shortest duration you could ever imagine of a stock would be 10 years. So if you divide by 10, you get 2 basis points. And that's probably a duration that's too short. So it's in the ballpark of what we expected, of what the theory said the effect should be. We don't get anything for the return. We didn't expect to get anything. Yeah.
A question on your time series, and ESG is so new. The beginning of your time series, I don't know how many people even were aware of the term ESG and the assets under management for part of your historical time series versus today. How do you think about that?
Yeah, I mean, that's a problem. I can't invent data. And you're right. I mean, if you look in the last 10 years, the numbers aren't that different, but 10 years is probably not enough. And this really became 5 years. But, 5 years of data is not enough. It just isn't. There's too much noise. So we can only do what we're doing. But, and of course, everything's a power issue, right? So you could always say, if I don't have power, I'm not going to find anything, right? And so I need data to get power. So, there's all I can tell you is I didn't find anything. I agree. And I guess another way, here's a better answer. When we don't have data, we rely on theory. And the theory is very convincing.
So, question over here. Hey, did you run it through another type of analysis, like a general linear model, to try to see if any other covariance, like any other, like the any other financial events or other type of geopolitical events might have removed some of the variance and produced a stronger effect size? Like general linear model is the one I go to, but there's other ones as well.
Yeah, okay, but they would have to be correlated with the event of entering the index or leaving the index. So I don't, I mean, identifying
the COP20. I'm just throwing out some ideas. Some of the carbon reports. Maybe those those events could be entered into the GLM, and then see if that entered and be different covariance in order to see, if that removes some of the variance in the data. That's an idea.
Yeah, I don't know why that would help, given we're looking at the event of them moving in or out. I should say that the one thing we did look at is
it would be a trailing effect.
Yeah. So I'm about to say. So we did look at that. So here is the lags. They used to be there. I thought that. Why is it not there? Hold on. Let me see. Is it? I guess it was. I guess interesting. Yeah, and maybe when I emailed the file, I didn't. Okay, I have on my computer the lags. What you do is, if you look at the lag, you lag everything. Nothing changes. It's still very, very small. Because you're right. It could be the fact that the capital is slow to react to the announcement or whatever caused the ESG change. I mean, I'm totally sympathetic to the argument that we don't have enough data, and I think that's true. I would say even stronger. I would say a lot of people manipulate the data because they pick time periods and everything to make claims, right, in the space, and I think that that's also reasonably irresponsible. I mean, again, we should rely on theory. It's a logical inconsistency to both say ESG investing is a positive net present value investment. It's going to give you higher returns and it's going to do good, right? Or I shouldn't say it's a logical inconsistency. What that means is you think managers are idiots, right? That's the only thing, because if they didn't take on this positive NPV project, right? So, said that way, I think, so from a theoretical standpoint, it seems to me that any ESG strategy has to have as a starting point that it's a negative NPV project, right? Because otherwise managers would have already done it. It should be, right? You're doing social good. You're not maximizing shareholder wealth. You're maximizing social wealth, right? And so I think, regardless of what the data says, that's the responsible way of saying to people, look, it's fine. It's like any other charitable thing you do. You want to do good, so you're going to do whatever you're going to do, but it's going to cost you. And I honestly think that we do a huge disservice to our profession by a universal ability just to go along with this. I mean, right now the SEC is thinking about requiring climate disclosure, right? But not requiring disclosure to people of what the hell it means to invest in ESG. It's perfectly okay for money managers to walk around and tell people, I can make you a higher return and you can do good at the same time, right? I mean, that's quite a statement, right? And certainly in aggregate, that's impossible, right? So I think we could do a better job of that. Yeah.
The principal agent problem. So, for example, maybe it's your incentive as an executive is 3 to 5 years, but the impact from a tail risk perspective is really over a 10 to 30-year time horizon. So you have somebody maximizing their individual wealth at the expense of the larger company.
Yeah, I mean, it could be. I mean, it's a hypothesis. I would go, hold on. where I really diverge from this is we often hear this. It's not only about the environment. Our managers are short term, blah, blah, right? At the same time, we hear about how great venture capital is. Phenomenal investment. Well, those two are inconsistent with each other, right? When you're investing in a growth company, the only reason you're investing is because the managers care about the long term. And you never say in that case, oh, well, these are just short-term managers. So I think you've got to decide. You've got to pick. You don't get to say sometimes, oh, managers only care about the short term in this world. But no, in this world, they only care about the long term. It seems to me that it's a little naive, that in fact, managers care about, the reason they care about the long term is because the stock price reflects the long term. Okay, and if they want to raise money and they want to go to capital markets, the stock price determines their ability to grow. And so then they have to convince capital markets that they do care about the long term. And we see ample evidence of that. You know, I have a textbook as thinking we're doing the latest edition. And in the real options chapter, I decided we should add a box about who's the vaccine manufacturer? Pfizer and Moderna. You know, Moderna is an unbelievable company. Moderna went public with absolutely no products whatsoever after spending something like $5 billion, and they raised $3 billion on the IPO. Something ludicrous like this, with no prospects, no products, right? And if you looked at that, you said, why would anybody pay for this company, right? A real understanding of the real options and the fact that management were very long-term thinking, right? It's a wonderful example of exactly the opposite, that in fact, capital markets, there's tons of money for long-term thinking, right? You can raise money, and you know, one of the strange things about America today is this angst we have about our system. I mean, I think it's an absolutely remarkable event that there was this company in private markets with no governments, right? Right? That people were funding in private places that saved the world. You know, it's a remarkable justification of why the system works and why, if we rely on governments, it doesn't work so well. So, yeah, what did he say? It was a Dolly Parton. It was a commercial. It was the thing. Well, I mean, I just think that we should be more careful about doing the science, right? Doing the science. This is what the science says. There's no politics in this. You know, when Berkeley decides, I mean, Berkeley's crazy. I mean, you know, I love Berkeley. It's a real shame to watch the university degenerate. But I mean, you know, at least this latest proposal, they won't even allow you, if you're a Berkeley employee and you have a 403B plan, right? So we normally think that if you have a 403B, you have the right to invest in whatever you want. That's what the plan is. They will not allow you to invest in oil stocks. There was some newspaper article. You go through the brokerage window, yeah, until you make it out. Exactly. They think they know how you should invest your money.
Oh, easy nudge there. Okay.
Yeah.
When you talk long-term, I hope you will extend your study into the bear market, because attitudes could change significantly. People are more willing to take risks in a bull market, expecting the market will bail them out. You may have more emphasis on dividends or other kinds of stability that you don't have in a bull market. So I wonder if you have had any thoughts on this, or if you think it's an all relevant thing to think about.
So the 87 crash, sorry, the 2008 crash is in the data, right? So we did see that. And that, I mean, I'm not sure how much of a bear market we're going to have now. Yes, I don't know what that means. Yes, there was a portfolio though.
There was, but I remember that time very well.
I agree.
Because I had two talks, one on extreme risk and one focused there and back. And when I would get up, I had a big audience for the first one. And when I gave the second talk, 90% of the audience
Yeah.
they just thought it was so I agree. whoever said it before, the data from that time to be able to sketch.
I agree. I'm no way am I disagreeing with that. No. I will say that the first study that I know of in this area studied after the end of apartheid. After the end of apartheid, it studied the effect of divestment in South Africa on stock prices and found nothing.
I'm like a huge fan of the beginning part of this talk that says that you need a big consensus to make a difference. But given how diverse our views of what is a good company, or maybe there aren't, in my own opinion, there may not be one, how are we ever going to get a consensus? You have people who don't want private prisons, you have people who don't want tobacco, you have people who don't want contraception, you people who do want contraception. Right there, you can't, if you can't get people to agree on what's the expected return, how are we going to get them to agree on an ethical?
I mean, obviously, companies are it's like journalists. Papers, newspapers and television, they're on their business of telling the truth. It's a complete naive. They're in the business of making money, and portfolio companies and brokers, they're all also owning the business of making money. So you don't expect them to tell you the truth. But if they were to tell you the truth, what they should tell you is, if you are divesting yourself of a tobacco company because that makes you feel good, go ahead. But if you're divesting yourself of a tobacco company in hopes that it's going to make a difference, you're dreaming. It cannot make a difference, right? So if you want to do more than just make yourself feel good, if you really want to do a difference, find something else to do.
I get a microphone now, so I agree with you, but I worry about studies like this because I'm so confused about what the notion of good is. What about Facebook, right? Didn't they just bring down the world, according to some?
Well, I mean,
company.
It's ubiquitous in the investment community, this divestiture strategy. We've got tons of companies telling managers that that there are some stocks that are off limits. We've got endowments telling managers that there's some stocks that are off limits. The Stanford endowment does not invest in coal. I mean, there is no basis for doing that, right? And if any organization that something like the Berkeley pension plan, right? Berkeley's not a good example because the state's on the hook. Let's go to a normal university which has a defined contribution pension plan. Well, actually, Berkeley's fine because it's taxpayers. The fact that they are making a decision to do something which does no good whatsoever, just makes themselves feel good, but changes the return of the portfolio in a negative way, is irresponsible, right? Just irresponsible. In other words, what?
From a fiduciary, yes.
Yes, absolutely. They're supposed to be fiduciaries. In our case, it's the state pays the California, because if FAN doesn't pay, the state, the taxpayers, it's irresponsible. You shouldn't do that. If it's your money, you can do whatever the hell you want with it. But if it's not your money, I think the correct approach is to explain it cannot make a difference.
Can I ask you a question about the paper? So did you make an assumption or in your kind of investigation that this is only related to public companies, or did you also think about private market?
Yeah, so we can only do public companies because we only have things. But again, it could be different. But again, you'd have to make an argument to me why this doesn't represent, we can only look at the public sector, but you'd have to argue that the private sector was fundamentally different. I don't see it. I mean, it reminds me of private equity funds. I mean, I know they've stopped this to some extent, but they used to walk around and tell everybody they had low betas. You guys are levered. Are you saying to me the private world has a lower beta than the public world? No, right? It's the same kind of thing. There's no reason to believe that the beta of private, of course, you may measure it once every 4 months and then pretend it was constant in between those months and get a low beta. Right. And maybe that's what we should be telling our investors. But it's the same thing again. I think that absent evidence to the contrary, we can assume it's the same.
Yes, we can assume it's the same, and I'm not arguing with that. I was just wondering if you included that effect in there. But the second question would be then your argument about that you rather invest into the companies from divesting a kind of attitude, and that makes sense. Can you elaborate on something like popularity context, like for example, the GameStop company is just basically this entire proposition is more, it's like more of a marketing exercise.
That's a good point, and I should have said something about that. Obviously, this is under the fully rational world of the capitalized pricing model, and it's hard to imagine that GameStop fits into this model very well. So if you think that GameStop is the general rule, this is not going to work. I understand you could have a very small company where investors can work and manipulate things, but I just don't think it's replicable.
That's right. But your gamma or participation kind of in this exercise is like how many like bad companies are out there, and you consider the investors.
So if you could, that's true. If you could coordinate, or of course, if you coordinate one company, you don't need very much, right? Because VD, right, goes to essentially one. The correlation goes down. It's one company, right? And so you could have one effect, but as you say, people aren't that coordinated. So,
but wouldn't you say you need like at least 50% of all investors in order for that to matter at all?
Well, if it's one company, you need much less because they're all
no, for the market, like
for the market, much more. You need 80%. I just showed you. You need much more than 50%. Let me say this: that there is a role, right? I mean, I think the irony of ironies is that actually Elon Musk is demonstrating the role right now. So if you have a monopolist and you take that monopolist over, you can absolutely affect change, right? So there is a role to affect social change in the economy. So if you find a monopolist and you take that company over, you can change things. But that's a pretty high criteria. If it's a competitive market, you're going to do absolutely nothing, even if you take the company over.
So I think we need
it's fine. Okay.
That was great.